Okay, chapter 9. This is the last chapter that we need to cover before the exam. And the learning goals today, we're going to talk about the sources of capital, the cost of each type of funding, calculating the weighted average cost of capital, and then the construction and use of a marginal cost capital schedule. So that's the things we're going to go over today. So when we talk about capital, that's another word for money. So capital is money. And companies need capital to expand their businesses, to start their businesses, to buy new investments, to continue on. So if you have a company that has a lot of capital, like Facebook, then you could spend $2 billion on a virtual reality company, $19 billion on WhatsApp, and they have the capital so they can go and buy other companies and spend ridiculous amounts of money. So your goal should be develop a small company that's something that Facebook would likely want to buy, and then you can be an instant billionaire. Quickest way to be a billionaire. Uh, the Now, things that are going to affect the cost of capital are going to be the economic conditions. So interest rates are going to be the number one thing affecting cost of capital. So for you, if you need capital in your life to fund a college degree, so your sources of capital can be credit cards, bank loans, student loans, loans from parents, and you're going to want to prioritize them in whichever the cheapest. So if your parents will lend you money at zero interest rate that you could pay back at a later date, that's probably the money you want to take first. If you get scholarships that have no interest and you don't have to pay them back, then that's definitely the money you want to take first, the scholarships. Then maybe money from your parents, then maybe some student loans, then bank loans, which are higher interest rates, and then the last thing you want to do is borrow from your credit cards, the highest interest rate. So you would want to, the same businesses do the same thing. They want to look at all the different sources of capital they have for themselves. In addition to that, one other source of capital for you and for companies is actually working. So if the company operates and it makes operating income, that money the company makes is capital. And if they retain it in retained earnings, that's capital. Just like if you go out and work in the summer and you save up money to pay for school, that's capital too. And it's a good type of capital because you don't have to pay it back, and there's no the cost to it is the actual working of your work or the company. But once that's done, you have the capital and you can redeploy it. And in your case, in your education. So if you had a job that paid you enough money to cover your education, it would be well worth it. That's why some people seek out jobs upon graduating with your bachelor's degree. You may want to work at a company that gives tuition reimbursement. So they'll pay for your master's degree. And that's a great, source of capital right there. And a good reason, even if the job may be at lower pay, you're still getting a certain amount of money in benefits, and one of them could be the tuition reimbursement. Okay. So market conditions are also going to affect risk. Is it a conducive environment for growing a business, or if it's a recession, expansion, those types of things? Operating decisions. These operating decisions are going to affect business risk. The riskier the business, the more you're generally going to have to pay for capital. So if you're a risky business, bank's going to charge you more interest. Bondholders are going to charge you more interest on corporate debt. So it has to do with risk. Just like if you want to put money in the stock market, there's a chance you can get zero or a negative return. But there's also potential to get if it's the S&P 500 in the last year or so, a double-digit return. So it's all about the risks you're taking. So if investors are going to take bigger risks in your company, they're going to need a bigger return, and it's going to be more expensive capital. So if you break down these operational risks, you can break it down to business risk and financial risk. Business risk is the risk that the company is going to fail. So the business risk would be the company, something's going to happen, a competitor or substitute product, or just the business itself is no good, is a separate risk from financial risk. So financial risk is going to be the company's not going to be able to maintain and pay back its current capital obligations. So financial risk would be a company taking on too much debt and then not being able to repay it at a later date. Okay. And then also the amount of financing. The more these companies borrow, the higher the additional cost of capital become. So sort of like the first 100 million they borrow for a big company, maybe that's at a 6% corporate debt rate, but then the next 100 million could be at 8%, and the 100 million after that could be at 10%, because the more the company borrows, the riskier the company is, and the more compensation investors are going to need to compensate them for that risk. So these are all things that can affect the cost of capital. So you have to understand, the people lending money, they're not stupid. So they're going to look at businesses and they're going to judge the overall risks. And if things are risky, they're going to want more return, which are higher interest rates. If things are safer, there's a difference between lending money to Microsoft or Apple. So if Microsoft or Apple do a corporate bond, which they don't need to because they have plenty of cash, but if they did, they pay very low interest rates. But if Twitter goes out for a corporate bond, their interest rates are going to be much higher because they're much riskier. So now what we want to do is compute a weighted average cost of capital. So you need to have a blended cost of capital. So when you have capital, there's multiple sources of capital, and you have to find an average rate, which makes it easier. So for example, if you have a choice, an option to invest in buying another company that's going to return 10% to you, you need to figure out what your weighted average cost of capital is to see if it's worthwhile. I'll give you an example on your terms. Would you borrow take a cash advance on your credit card at 22% interest rate to invest in a certificate deposit that pays 4%? No, that makes no sense, because you're paying 22% interest on money you're investing to earn 4%. It's the same concept here. Companies need to check that the money they're borrowing is going to be at a lower cost than the return on the investment they're going to put the money into. For example, you're going to college and you are borrowing money in some fashion or utilizing capital to invest in your education. And that could come at a high rate of interest, say 8%. But the return on this money is much higher than that. So you may spend $40,000 on a college education at Stony Brook or more, and you may pay 8% to service that between all your different borrowing and such. But if your return is going to be $1 million of additional salary, that's well worth it. So that's why students keep borrowing money at higher costs, and that's why even though tuition goes up and the cost of borrowing to go to school goes up, you still do it because there's still a huge advantage to getting that college degree. Okay, so to continue, we have to, in order to get this weighted average cost of capital, we have to determine the percentage of source of each capital fund. So how much money are we getting in each particular source? So constructing an optimal cash structure basically says what's the best mix of capital to make a perfect capital structure. Just like in your case, when you're planning to go to college and you need X amount of money to fund your college education, you should have spent some time thinking about what would be the optimal capital structure. Not just running out and getting loans right away, but actually taking the time to apply for scholarships, to talk to your parents about borrowing money, or setting up some other types of capital at a lower cost. And then, of course, once we have these different, to do any type of weighted average, we need the percentage of the source of funds and then the cost of the source of funds. And I'll show you later how to calculate that weighted capital. Okay, so the first common source of funds for businesses is debt. And debt basically means they're borrowing money, usually in the form of a corporate bond. No, I take that back. Usually as the form of, we can say a corporate bond. Could be a bank loan too. That's what I was thinking. Now, if you want to know more about corporate bonds, you can read ahead on Chapter 12, but you don't need to know too much for this chapter other than we're borrowing money from people and we have to pay them interest on that money. So people lend us money for a certain period of time, say 10 years, and we pay interest every year. And at the end of that 10-year period, we pay the money back. Now, what we're going to use is K to the small d to denote cost of debt. And let's suppose a company issues bonds with a before tax cost of 10%. Now, the interest that a corporation pays on bonds is tax deductible to the corporation. So we have to take into account that this is tax deductible. So we have a formula, ATK to the D, which is after tax cost of debt. And we take our full cost of debt and we multiply it by 1 minus the tax rate to get our after tax cost of debt, because this is what we're actually paying. Just like if you were going to buy a house and you want to calculate your after tax cost of the mortgage. So if your mortgage is at 5%, if you factor in that your interest payments are tax deductible, your mortgage may actually go down to may really be 4% cost of debt after you've taken your tax savings. All right. Now, a second source of capital would be preferred stock. And preferred stock is sort of a hybrid between bonds and stock. And it's the best of both worlds, some companies say. So basically, they're borrowing money from investors for which they're going to pay a dividend on this money. But it's a perpetuity. You never have to pay back the initial money you borrowed, you just have to keep paying back the interest. So you could borrow $1 million and you never have to pay it back with preferred stock, but you will have to pay the interest on this $1 million forever, unless you voluntarily decide to retire the preferred stock. Otherwise, this is a continuous type of debt. And to calculate the rate of return, we use K to the small p to denote cost of preferred stock. So if we take the dividend of the preferred stock and we divide it by the market price minus the flotation charge, and we get the actual rate of the preferred stock. And so some companies, just like in the Zoom simulation, you want to take a mix between long-term, short-term, and issuing stock. There's no preferred stock in the Zoom simulation, but you have an option to borrow in get additional funds in 3 different buckets on the Zoom simulation: long-term, short-term, and stock equity. So if you try to borrow all your money from one of these three sources exclusively, it becomes very expensive. So companies have to kind of manage how much and where they're borrowing their money from. They don't want to borrow it all for one person. You know, for example, say you have 2 parents and maybe they're separated or divorced, and you have 2 parents, and it'd probably be easier if you want them to help you with school to get money from not one but both parents. Say they have equal income and equal savings or whatnot. Rather than just trying to borrow, there's only so much money one parent can lend you, but that's why you'd probably break it up between the 2 parents. And then you would also go out to student loans and scholarships and maybe a work study, whatever different sources you could get, because if you only do student loans, then you're going to graduate with $50,000 in debt, and that's about probably $800 to $1,000 a month in student loan payments when you graduate. It's too expensive to go only to that student loan source. So you want to mix up as many additional sources, including you working to help pay for school. And that's what companies do because it helps keep the cost down. So preferred stock is one of those methods. So as an example, if we issued preferred stock with a dividend is $5 a year, and the cost of the preferred stock, the price of the initial preferred stock is $42, then we'll get the cost to be 11.9%. Now, when we talk about equity, there's 2 types of equity that we're going to talk about as far as equity as a capital source. The first one is retained earnings. So you know that when we've been doing these income statements, all semester long we've been doing income statements, and the money that a company makes, they can either pay out as dividends and or retain it as earnings, or a portion divided up between the 2. So whatever money the company retains, that comes at, considered internal equity, and it comes at a cost. So if a company is going to retain money, investors are going to expect that they're going to get a return for that money. So it's the obligation of a company to retain the earnings and then hopefully grow or invest in other businesses. A company can also issue new shares of stock. This is what you're doing in a Zoom simulation. You're actually doing both. When your company makes money, you're saving into retained earnings, all of it, because you can't pay dividends in that. And you also may be issuing new stock. So the combination of the retained earnings and the new stock you're issuing is additional sources of equity capital. And hopefully you're taking that money and you're investing in additional investments in the company, because you can't win in a simulation unless you've been buying investments in additional forgot exactly what they call it, but there's a part in the operations page down below where you can make additional investments into the company that help you to reduce your costs. If you haven't been doing that, you're going to find it's going to be difficult to keep moving ahead in the simulation. And that's the same thing for companies. If companies are constantly, they're like a shark. If they stop, they can't breathe and they die. So companies constantly have to move forward, expanding, growing, solidifying, improving operations, investing in new equipment, evolving. Otherwise, they'll just be completely overrun by the competition. Okay. So actually calculating the cost of common equity is going to be there's going to be multiple calculations depending on whether it's new stock, or we're issuing, or it's existing stock, or it's retained earning. And companies should only retain their earnings if they have a decent plan for generating additional returns on that earning. If they aren't, they should pay it out as a dividend. And that's been a complaint a lot of investors had about Apple and Microsoft, is that you're making all this money and you're just putting billions of dollars in the bank. We're not getting much of a return for that. Either pay us out a dividend for those, or find a new business to expand into. All right, so the cost of internal equity is going to be the opportunities that they could use those funds for. So if it's very undesirable if a company makes a lot of money, they retain that earnings and they do nothing with it. They just put it in a shoebox in the president's office. So they're not getting any return from the bank. They're not investing in any of the companies. They're just leaving the money in a filing cabinet. Millions of dollars. So you see how that investors would not like that. So they want to take this internal equity that the company generates and reinvest and grow the company. Okay, so there's two methods for determining it. We could use a dividend growth model as one method of determining the cost of capital for equity. And we could also use the capital asset pricing model. So we're going to look at both. Okay, so if we look at the dividend growth model, what we want to know, one way of value of putting a cost on equity capital is looking at the dividends that the stock pays. So for example, the more dividends, that's the cost of the equity, is the dividends. So we look at D1 would be the dividends next year. The 1 or the number next to the letter denotes the year. So 0 would be right now. 0 is the present. 1 is next year. 2 is 2 years. 3 is 3 years later. So you may see that in some problems. But here we take next year's dividend divided by the current price, and G is the growth rate in the dividend. So that's why it's called dividend growth model. Some businesses will announce they're going to grow the dividend at 2% every year. So this way we could actually figure out the costs of the capital based on dividend and the growth rate. So here we have a stock price of 60, $3 in a dividend that was just paid, and the expected growth rate of 10%. Okay, so if we put that, we're going to put that to work. And let me just move this down a bit. Okay, so here you see cost of stock. We take the $3 dividend, but this is, since they said the dividend was just paid, that would be considered D0 because just is right now. So we actually elevate the dividend to next year, which means we increase it by 10%, divide it by the $60 and add 10% to it, the growth rate, and we're going to actually come up with a cost of capital, which is 15.5% for internal capital. So again, if you want to calculate the cost of internal capital, you need to know, and this is only usable if the company pays dividends. And this would tell us, because that's, if we're getting this money and we're promising to pay dividends on it, that's the cost of that capital. Just like if someone If I was to lend you $1,000 and I say that you have to write 3 term papers each year that you have that $1,000, that would be the cost, which would be a time cost for you to borrow that money from me. And then once you pay the money back to me, you no longer have to write those term papers. So that's a cost. I might just simply say you give me $100 every month for each month that you have this $1,000 of mine. So you would see that that's a high cost. You want to pay that back as soon as possible. Okay, so if we look at common equity, now what if the company does not pay a dividend? Well, we could use what's called the capital asset pricing model for companies that don't pay a dividend. And what we can do is we could break out K to the S is the cost of the stock. So K to the S is the cost of is what we're trying to calculate, the cost of stock. Now, RF signal is the risk-free rate, and the risk-free rate is, we could look at that to be a 3-year treasury rate or a rate of return that's safe from default. And we're going to add that to the beta of the company, and the beta is the risk level of the company. So beta is a measurement that we apply to the correlation of the company's stock price to the market, and we develop how we figure out through dispersion how risky the company is. So B is a measure of risk, and we multiply that measure of risk by the market return less the risk-free rate. So we're magnifying the market return after we take out the risk-free rate. So if the market return was 12% and the risk-free rate is 2%, we only want to magnify that 10%, because within the market return is the risk-free rate already built in. So we want to strip that away, just get the pure market risk and elevate that by beta, and then add the risk-free rate back into it. So we don't want to amplify the risk-free rate. That's why we strip it out. So if this stock had a beta of 1.2 and the risk-free rate was 5% and the expected market return was 13%, we could just substitute those percentages into the formula. So we take the risk-free rate of 5%, we put it here and here. We take the beta, we put it here. And the market return, 13%, we put it here. So in any of the homework or possible test questions, I will give you the variables, and you just need to know this formula to calculate the cost of equity based on risk, specifically for companies that don't pay a dividend. And this would equal 14.6%. And again, the only way to mess this up is if you don't know your order of operations and you don't know that you have to, please excuse my dear Aunt Sally, parentheses first as an acronym. You may use PIMDOS. That's the millennial acronym. Right? Did anybody use PIMDOS? Anybody use please excuse my dear Aunt Sally? No, that's old school. Oh, you use that? All right. You must have had an older teacher. Now, cost of common equity, new common equity. So what if we're not worried about retained earnings or existing, but we want to issue new stock? Okay, so this has a different parameters too. We can adjust the dividend growth model, and all we're going to do here is subtract the cost of the flotation costs. So if you're going to issue new stock, there's going to be a cost to that called the flotation cost. So when a new stock gets issued, the investment bank is going to get money per share. So if we're going to issue a new stock at $25 a share, the investment bank's going to say, you're going to pay me $2 a share to do that, because I have all the lawyers, I have all the accountants, I have all the connections to the brokerages. So if you want to come out with new stock, you have to come through me. That's really the only way of doing it. And I'm going to charge you a flotation cost for doing that. So this would be the cost of new equity. So it's just modifying the formula to add this flotation charge in it. So if we had these variables, we have the flotation cost will be 12% of the price. So we'd multiply, if the price is 60, multiply it by 60, get that percentage and subtract it from it. A lot of times the flotation cost will be a full dollar amount, it won't be a percentage. But if they do give you a percentage, you just multiply it by the current stock price. And with the dividend, you have to know what year they're expressing the dividend in. If they say next year's dividend, then we have D1, you don't have to modify it. If they're saying the dividend, present dividend or dividend right now or the dividend just paid, that's D0. And we have to elevate it to D1. just like if to personalize this for your life, I'm going to say you have a job, you make $10 an hour. That's your D0, $10 an hour. Next year, I'm going to give you a 10% increase. So what's your D1 for next year? Which is, what's 10% of $10? Right. So how much are you going to make next year? $11 an hour. Now, if you worked for me, if you said $10.10, I'd be like, that's right. That's what you're making next year. But it's as simple as that. So where dividends are like income and you get raises to them, and that's the growth rate. So here, the only difference between new stock and common equity is that we have to subtract out the flotation charge of the new issuing new stock. Okay, and that'd be 16.25%. All right. So now we calculated the cost of bonds to be 10%. They calculated the preferred stock at 11.9, the retained earnings at 15%, and new stock at 16%. Typically, new shares are more expensive and they have a higher percentage. And if we have a tax rate of 40%, we're going to need to know this tax rate of 40% to calculate the cost of after-tax cost of debt. Okay, so this is the weighted average cost of capital formula that we're going to utilize to calculate the weighted average cost of capital. So it can be denoted also, weighted average cost of capital, we could call it a WACC, or K to the A, and A would be for average. And we're basically taking the weight, WT stands for weight of the debt, and we're going to multiply it by the actual rate, or the after cost of debt. Then we're going to add that to the weight of the preferred stock times the cost of preferred stock, and we're going to add that to the weight of the common stock times the cost of the common stock. So it looks like a big formula. It's actually pretty simple. We're taking the weights, the individual weights of each source of capital, and we're multiplying it by the individual rates, and then adding up the sum of that. All right. So if we were going to add this up, and we see the formula at the bottom here, slow as it goes. We take the 40% cost. The 40% is the percentage of debt in the equity pool. 10% is the percentage of preferred stock, and 50% is the percentage of stock. So together that's 100%, and we multiply it by the corresponding costs. So again, the weight times the rate, and we have this weight times this rate. The X here denotes multiplication, not another variable. And here 50% times 15%. Add these three calculations together, and we'll have plenty of opportunities for you to do this by hand, and we come up with the weighted amount. All right. Okay, so if we're going to use new equity, we would just replace the cost of stock with the new equity percentage rather than the retained earnings percentage. So that's important because they have to give you instructions. When we're calculating next year's weighted average cost of capital, are we using the existing equity in the company, or are we going to go and issue new equity? So we need to know those in the instructions, especially in the problems, to figure out what we're going to be calculating. Now, the marginal cost of capital is looking at the next level. So if we can kind of say, what's all of my existing sources? How much more can I borrow in debt, equity, and preferred stock right now before the prices go up? So I can have my present weighted average cost of capital, or maybe the capital I've already borrowed can be my present weighted average cost of capital. Marginal would be if I go for a second round of borrowing and the costs generally go up, the more, and you'll see this in the Zoom simulation, the more money you borrow, if you looked at interest rate, it starts increasing on the other side. So if I go for my next round of borrowing and I'm going to pay more for my long-term, my short-term debt, long-term debt, my preferred stock, and my equity, what's going to be my new cost of capital, and we call that the marginal cost of capital, or the amount that we're going to pay for the new round of equity. New round of capital we're going to borrow. So when a company looks to raise money, they want to project what the future costs are going to be for raising that next round of money, because they're going to need that to match it up to what the returns are on where they're investing it. So if you see this MCC, it's a marginal cost of capital, which is basically the weighted average cost of capital, but extrapolated to next year's borrowing. Okay, so let's assume that this corporation has $100,000 in retained earnings, which is going to use in its capital budget. So we could calculate the point at which it needs to issue new equity, and we'll say that their budget is going to be 50% stock. So if we know how much money they have in retained earnings and the budget is going to be 50% stock, we could basically figure out when we'd have to borrow new sources of funding. All right. And this is basically how we calculate a break-even point. So if we take the available retained earnings, and here it's 100,000, and divide it by the percentage, 50%, and this, can anybody do this number in their head? I'm thinking 200%. 200,000. All right. So 200, if you do the 100,000 in retained earnings, so you take this 100,000 up here, and that's your available for retained earnings, divided by the percentage, 50% of our capital pool will be equity, we'll get the break point. So if we have a budget bigger than 200,000, we're going to have to issue new stock. That's basically what we're doing. So we're figuring out, if I have 100,000 in retained earnings, how much can be the total size of my capital budget if that was going to represent 50%. So that makes sense. If 50% is retained earnings, the other 50% is something else. So together, 100,000, 100,000 is 200,000 is my entire budget. So if I'm going to do a $500,000 investment, I know now I'm going to have to issue new stock. So that's why we do this break-even point. And the break-even point can be on bonds as well. You substitute the amount of money you're going to borrow at the current rate for the total percentage. So here's the actual calculation. I should have just went to the next slide. 200,000 is the total. That's the break point. That's our breaking point where we have to actually go out and get new stock because we used up all our retained earnings on a $200,000 budget. We can, of course, plot that on a chart, and we'll say that using just internal common equity, we can do it. We'll have a weighted average cost of capital of 11.9% up to 200,000 in financing. After that, we're going to have to issue new capital, which comes at a flotation cost. So the next up to 400,000 is going to be an increased cost of capital of 11.72%. Sort of like if you had one credit card from Capital One and you wanted to get a second credit card, that second credit card may be at a higher interest rate because you're riskier and you're taking on additional debt. So if we had projects, I'm a company and I have 3 projects here, and I'm looking at the rate of return. So if the first project's a 12% return and it's going to be only 100,000, that fits within my current budget of 11%. So I would do that because I pay 11% for my borrowing and I make a 12% return. The second project, I'm going to make a 12.1% return, and we're stacking them up in order of from the most return to the least return. And you'll see the second project, it's going to actually use up all my capital. I have to issue some new stock, but still the return of this project is higher than Capital Pool 1 or Capital Pool 2 at 11.72%. But the third project at 11.5%, would not be advisable to take on this project because I'll be paying more in my cost of capital than the project will return. So companies, you may be, say you're a pizza restaurant and you're looking to expand and buy 3 other established restaurants. project 1, restaurant 2, and restaurant 3. You would just buy project restaurant 1 and 2, and you would forget about 3 because the returns wouldn't match the cost would be to borrowing that. Just like if you were going to buy a house, and if your house is $300,000, the bank will set you up with a regular mortgage for 5%. But you looked at another house, you also want to buy a $750,000 house. They're going to charge you a jumbo loan, and the interest rate's going to go to 7.5% because now it's riskier and you're borrowing more money. So that's how we kind of use the weighted average cost of capital to line up and figure out, if we're looking at our internal rate of return, what projects to accept, what projects to reject. Okay, so we would accept projects 1 and 2 here. All right. Okay, so that's the basic lecture for Chapter 9. Now I'm going to go over on the chalkboard a couple examples of these formulas that I had done in the PowerPoint, because the PowerPoint is only so good because it gives you just formulas that are hard to really interpret. So I'm going to spend some time in class going over and reviewing the formulas we just talked about. But before I do that, let's look at the Zoom simulation that's also due tonight. The next round, so I still haven't reviewed the last round, so I'm going to do it here real quick. So the folks at home can get this as well. Okay. Okay, so let's see what round we left off in. Okay, so we completed 4 rounds, so tonight we're working on year 5. And you can see here that this is the net profits per team. And net profits have been going up steadily, which is a good thing. So everybody's been able, pretty much for the most part, to increase their net profits. And that is critical. However, points have been leveling off somewhat. And remember, as long as you're getting over 400 points, you're doing well. So everybody in this class, just about every team, is still doing well. Because if we have 6 rounds at about 400 or 450 points a round, you're going to make the minimum points to get the A in the project. So just because, I don't want to hear it that you got 500 points and you think you're doing badly, because you're not. If you got 500 points or even 450 points, that's the average you need. So most of you are ahead of the game as far as getting the total points for getting the A in the project. So you're not doing bad. Maybe you think you're doing bad because you got 800 points last round and now you got 400 points. Your average is still 600, which is still higher than you need to get an A in the project. So you're doing well. It just gets more competitive as teams figure out how to compete better. As costs go up, it gets difficult to continually improve your score round after round, which you're still doing. But if you're not investing in the company, in operational investments, you're not going to be able to reduce your costs, and you're not going to be able to improve your profit margins. So that's something that every team should be thinking about. Okay, so if we look at the stock price, just about everybody's stock price has gone up, some more than others. So that's a good thing on stock price. And then here we see a team is flat. That basically means they didn't submit the round information in time. So there was one team we had that just failed to complete their round last round 4. And how does that happen? Well, there's a team of 3, and we're lazy, so we divide it up. You do this week, I'll do next week, you do the following week. So they don't work as a team, they work as 3 individuals. The person whose turn it was, I forgot. I'm sorry, team. Well, now you just screwed your whole team over because your team, but it's everyone's fault because they came to me and said, oh, well, I forgot, so I want to take all the bad, lost the points and everything. Don't punish the other 2 people because they weren't involved. I'm like, well, you have a very poor perception of what a team is. A team isn't, you mess up and you take the punishment for it. No, if you mess up, the whole team is punished. And that's why you need to work as a team. Um, it reminds me of the movie, and I saw this yesterday on one of the movie channels. Um okay, so the movie is Full Metal Jacket. Stanley Kubrick directs, who also directed The Shining. So in this movie, it's a platoon in the Marines. One of the Marines is constantly messing up, and he's causing the rest of the platoon to do push-ups and additional jogging miles. So what do they do to this guy? They take a blanket. They give him a blanket party. They take a blanket, and they hold down the sides of the blanket so he can't get out of the bed. And they take a bar of soap inside a towel, and they beat him with it to show him that, listen, if you mess up, it's causing us to mess up, so now you have to take your licks. So hopefully none of your teams are in that dire of a situation where you have to give someone a blanket party, which I don't recommend. But that's basically what happens. If you don't work as a team or one person fails the team, it can affect everybody. Sort of a... All right. Okay. So if we look at earnings per share, we have this team down here that has the same earnings per share every round. That's somebody who signed up for the class, created a team, and then dropped the class. So I'm just pushing them along, and they're just not getting anywhere. And this is the one team here that failed to submit their results. And team is D&M Auto. We don't know who that is personally, but D&M Auto didn't complete their round. Most teams here had escalating earnings per share, and for the first time, Phoenix rose, just like a phoenix from the ashes, rose to be number one in earnings per share and finally beat Cars LLC. Although an astonishing slope here would be Stony Brook Autos, who had, I think this is them, who had the biggest increase percentage-wise in stock price over here to come in fourth, where they previously were in like 8th place. Only one team had a reduction in earnings per share. FRCM Enterprises, their earnings per share went down. The only team whose earnings per share went down. So why did that go down? You let your profit margins go lower, or you spend too much in advertising. You really need to look into that. Why would you should never let your earnings per share go lower. If any stock in the stock market today comes out and says our earnings per share are going to be lower than last year, the stock gets devastated. So you don't want to do that. You always want to make sure you're increasing your profit margins. And the pro forma financial statement will give you an estimate of what next year's stock price is. So there should be no reason for having a lower stock price. All right, so before you do round 5, are there any questions about the simulation for the current round? No questions? Okay, so my advice to you to do well in round 5 is figure out what your current average profit margin is. How do I do that, Professor Nugent? Well, we just learned that. You take your gross profit divided by your sales. It's a financial ratio. So go to your pro forma financial statement. You'll see last year's financial information. Take your gross profit divided by sales. That's your last year's gross profit number. And then when you're making your cars, it gives you the gross profit margin when you make the cars. Just make sure each car is larger than last year's average percentage. And that way you can guarantee, for the most part, you're going to have an increasing, and by this point, you should strive to get a 5 to 10%. 10% would probably be the most you could do, but somewhere between 5 and 10% increase in your gross profit margins from last year to this year if you want to earn a lot of points. Make sure that you're investing operational investments, because not only do operational investments make your cars cheaper for next round and your profit margins higher, you also earn points if you double your spending in this area. Operational investments on the overview side. You want to be careful of your forecasts. You don't want to under forecast or over forecast too much, and you want to work off of last year's demand, not actual sales. Yes. You're done. That's the most you could spend. So now you just sit back and enjoy the cost advantage you have over the other teams. You have to watch your advertising budget. You're in charge of advertising. Look at your profit margin. If you have a profit margin of $5,000 per car, don't advertise for $6,000 worth of advertisements per car, because now operationally you have a loss. So you want to balance all these things. You know, when you design your cars, make sure they have good profit margins and realistic sales forecasts. And for that, you have to do a little research. When you do your advertising, make sure that you're keeping up with your competitors, but you're not advertising so much that you're throwing money away. It's like the student, I remember talking to another professor, and he asked students to work on a local business and then to make an advertising plan. So one student, we were laughing because the one student owned a sandwich shop in the local area, and his advertising budget was to spend $1 million in a Super Bowl ad. The problem is that Super Bowl ad reaches the whole world, and your sandwich shop only reaches a population of maybe 100,000 around the sandwich shop. So why are you wasting? You know how much you could do for $1 million of advertising locally? And this is a business that only made 100,000. So you're going to spend $1 million in advertising and have a $900,000 loss. How does that make any sense? So use your common sense when you're doing. That's the point of that story. Operationally, make sure your capacities are high. Don't buy production plants you don't need, and make sure that you're not padding your forecast. So if you forecast you're going to sell 2,000 cars, don't build 2,100 cars. Build exactly and make that shortage or excess zero at the bottom. Don't try to, build extra cars just so you have them. That's only going to cause you to have extra inventory and lower your financial ratios. And make sure by this point, by year 5, you should have enough money to start paying down debt and retiring stock. So you should be in a profitable area where you can start paying down the maximum of whatever money you borrowed or stock you issued. Okay. That's the heat. All right, so, okay, I'm going to stop here.